viewers, I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ right here on ITV Gold. The show is sponsored by Science CPA Services, a complete professional full-fledged accounting firm, multiple locations in state of New Jersey. They can assist you with your personal tax matters as well as corporate tax matters as well. Give them a call at 908-888-8900. That's a 908-888-8900. You can visit their website, sciencecpaservices.com. And folks, even though the tax season officially is over, because we are now into almost second to third week of October 2025. So tax deadline was October 15. I hope that whoever filed the extension took care of the whatever your responsibility was, October 15. But now it is still a good time to contact CPA at Science CPA Services, because this is the time between now and December you can park your money in one of those plans where you can save your tax liability. It's not that you're going to get more refund, but you can save your tax liability because those plans allow you to park your money, invest your money into it, and that will reduce your tax liability. And especially if you're in a high-end income bracket, you should really do that. And Science CPA Services and their experts can definitely assist you with that matter. So don't think that you don't need to call CPA till January. This is the time to get in touch with CPA, to have them review your 2025 tax return, to see that how much money can you save when you file the tax return next year and what are the deductions you can get. So take my advice. It's a genuine advice. Give them a call at 908-888-8900. With that note, I'd like to welcome Mr. Ajay Kumar of Science CPA Services. He is a CPA, CVA, and MBA with over 25 years of experience, brings a wealth of knowledge, not only in accounting, not only in finance, but business as well. And that's why we bring this show for your information. It's a Tax Talk with AJ, and here is AJ. Sir, good to have you.
Thank you, Sanjay. Thank you for the kind introduction.
Absolutely. I mean it and I say it, and it is absolutely true, because, obviously we need to inform, educate our viewers, and if we can make a difference into their life and if we can give them a hope, it's fine, because many people are unaware. They think now, till next year, till year 2026, I don't need to do anything with the taxes. And then many of them, as you know, AJ, from your own experience, many of them, they say, oh, we are sorry, we didn't know that we could have invested money in November, December to take advantage of the tax savings. So that's why we really need to let them know.
You said it well, Sanjeev. There are a lot of people who come to us during the tax season, February, March, and how do I do?
Yes.
What can I do to save taxes? And we tell them that you could have done something before the year end. This is the time of the year, between October 15th till December 31st, we do a lot of tax planning.
Exactly.
Especially if you are in higher income tax bracket, if you are making more than six figures, more than $100,000, you must have a conversation with your accountant to see what can be done now. Can you open up another business? Do you have multiple businesses that you are not using that you can close down before the year end, so you don't have to do the tax filing for the next year? Can you invest into 401k? And remember, you cannot invest into 401k after December 31st.
Correct.
It has to be done prior to year end.
Yep.
There are a lot of tax planning that can only be done prior to year end. When it comes to Section 179 deduction, when it comes to bonus depreciation, all that has to happen prior to year end.
All
so
right.
Make sure you have a conversation with your CPA.
Very good. And that's why you need to contact Science CPA Services, 908-888-8900, or visit their website, sciencecpaservices.com. Having said that, folks, last week, our last episode was on a tariff issue, Trump's tariff, and that was the part one, because at the conclusion, we said that we'll bring in a part two in the next episode. That means in this episode, we're going to touch upon some of the issues that we missed out in the last week's episode, and that we said that it's a part two on a Trump's tariff. All right, AJ, so as we discussed, Trump's tariff issue at the length last week, there are a couple of things that we really missed out on it, and I really want to touch base upon it. Even though the tariff issue is really, really still hot, and President Donald Trump is making some comments here and there, It definitely affects the stock market. A couple of days ago, he just mentioned that he was going to raise a tariff to China of 100%, and that really made stock market go down historically. So these are the things that he continues to do. He does it. But AJ, from the very business point of view, why is Trump using tariffs? What's the main reason behind this?
Well, if you take a step back, there are several reasons for tariff, in my opinion. Again, President Trump is higher educated, much more experienced, and has a team of people who are deciding these things for him. But the way I see it, higher the tariff, people get discouraged to buy, to import material from outside the country. So in the long run, not in the short run, in the long run, some of this stuff, some of this manufacturing will move to domestic section.
Yes.
Let's say, for example, if atta flour is expensive to bring from India, people will start eating tortillas, not immediately, in the long run. So some of these things will move. I mean, it's a crude example. Second, tariff brings a lot of money to the US government. Some of this money can be used to reduce taxes. So when we talk about President Trump reduced the taxes from 39.6% to 37%. Now, QBI deduction has been made permanent. A lot of charitable contributions are above the line from next year. There are a lot of benefits. SALT deduction has been increased from 10% to 10,000 to 40,000 if you are making less than $500,000. So if you take a close look at this OBB one big beautiful bill, it's going to cost almost $4 trillion. Where is this money going to come from? So it's a zero-sum game. You have to run the government. The money has to come from somewhere. So tariff is a source of revenue for the government. In theory, if enough money can be generated through tariffs, through Trump card, through other resources, we don't have to have taxes in this country. I mean, in the initial days, President Trump said he wants to eliminate IRS and wants to have ERS. Instead of Internal Revenue Services, IRS, he wanted to have External Revenue Service, ERS. I think tariff is part of ERS planning. So I'm sure it's a thought-through plan. There are a lot of complaints around it, including me. Nobody wants to pay 50% extra. When it comes to India, tariff is 50%. I mean, it's absurd. You can't have 50% tariff on the food items. We can't avoid not eating those food items. So 50% is absurd high, and everybody's complaining about it. Nobody's liking it. But I think there is a bigger plan in picture.
Okay. Well, if there's a bigger planning in the future, as Donald Trump said that he really wants to have manufacturing here in the U.S. and everything else. Now, President Trump is 4 years, right? It's not going to happen overnight that the factories and companies are going to set up and they're going to start manufacturing. You know, you used the one example, atta, flour, and everything else, or many other things, right? Immediately, U.S. is not going to be able to get into manufacturing that soon and start manufacturing. And then eventually, as per Donald Trump, he's saying that U.S. should rely only on a U.S.-made products in everything, A to Z, whatever we use in our daily lives. That's not going to happen overnight. That hasn't happened in decades.
That's in theory. That's a 100-year plan. If things keeps going the way they are going, probably, and that too, probably in a lot of years, in 100 years, we'll get to that point. But you're very well said. The problem is the presidency is only 4 years, limited time. Even in this 4 year, I'm not expecting the manufacturing, forget about 100%. Manufacturing cannot be moved from one country to another country in 4 years. It takes a lot of planning around it, a lot of investment. And it's not easy, because if you're trying to manufacture anything in this country, it's not going to be cost savvy, it's not going to be cost effective, it's at least in the short term. Yep. Even with 50% tariff, bringing stuff from India is going to be cheaper than manufacturing it in US.
Absolutely.
So how do you avoid it? And that too, you have to make it all happen in 4 years.
All right. So now, as the tariff issue is definitely uncertain issue because you never know what's going to happen tomorrow or day after or even 6 months later or next year. AJ, I have one question for you now. How do you see tariff with the tax? Meaning, what kind of implications are going to be on the taxes because of this tariff, and especially what you're going to be seeing in this year's tax return when the taxpayers will be filing it next year?
Well, less about tariff, more from one big beautiful bill perspective. We are expecting the tax liability to be lower than what it used to be for the same or similar income bracket. The problem is when you have one big beautiful bill, how do you fund this one big beautiful bill? That's where the tariff comes in. So in theory, at least in theory, tariff should help reduce the taxes. And if tariff plan works out and get stabilized over next few months, it can create a situation when you have enough money in US government funds, not only our debt structure will be better, our debt will go down, US government can fund more projects and can give more incentive where needed. I mean, if you look at this one big beautiful bill, it's giving away a lot of money for small income people and for large income people as well. But again, it's not sustainable if you cannot fund it. You have to find a source to fund this type of bill. So in the long run, tariff can create a situation when a lot of tax initiatives, a lot of other domestic initiatives can be funded.
Okay. All right. Quickly, before we go into a break, AJ, we have a little less than 2 minutes, so you and I are going to split some time. We're just going to go over through 2025 tariffs and tax implications. This is prepared by Science CPA Services. So I'm just going to pick on one or two items. You also pick on the important item. One is that it's a fact that tariff could raise $5.2 trillion over 10 years. All right.
Which is more than the deficit created by the one big beautiful bill.
Yep. All right. The other one important note is business boost. Domestic manufacturers get a 15% corporate tax rate, which is also interesting.
Which is not implemented yet.
This is in a plan. This is the tariffs and tax implications. Implications are in a way of saying it that expected. Right. That's in the plan. So this is all in. Nothing is final. Inflation risk. Tariffs could raise cost and slow economic growth. This is one of the negative sides of it. We're just touching base upon the highlight of it. All right. Trade tensions. Tariffs on 57 countries spark retaliation.
It can. It already did. In the long run, it's going to stabilize. It's going to settle down. If you take a step back, all these countries have been putting tariff on U.S. export. So U.S. export and import are not balanced right now. So when we start with 50%, and let's say hypothetically it settles down at 10%. 15%. Even then, it's a huge win for the U.S. government. It's a huge win for the U.S. government to have a lot of money. 10% will turn out to be billions of dollars.
Okay. And the last thing I want to mention before we go in a break, this tariffs and tax implications is that big picture, overall, big picture of this tariffs may reshape federal funding opportunity versus risk. Ladies and gentlemen, these are the tariffs issues related topics and the pointers prepared by Science CPA Services and Ajay Kumar that we brought it to your attention. We're going to take a break. When we come back after the break, we're going to talk about small businesses. In our community, many businesses are called small businesses. So a lot more information coming your way right after these messages. Welcome back to the second half of the Tax Talk Show right here on ITV Gold. This weekly show gives you all the updates, information that you really need to know when it comes to taxes. But not only taxes related matters as well. Of course, business is one of them. Business and a tariff goes together. So businesses, tariffs, economy, stock market, investment, or related, all these matters where taxes matter. That's what we discuss in our show. And Ajay Kumar of Science CPA Services brings his knowledge and guidance and shares it with us in this show. The show is brought to you by Science CPA Services. Now we're going to discuss, in this part, about small businesses. And Ajay has a lot more information on the small businesses. Now, When it comes to small businesses, the important part to know is the tax planning for small businesses. You may have a company set up, whatever, LLC, C corporation, S corporation, depending upon your choice. That's a different thing. But the tax planning is a key thing, and tax planning should begin now, between now and December, so that way it benefits you next year. So AJ, let's start with the tax planning and important matters.
Absolutely, Sanjeevji. So the way we see it, this is the year of change. A lot of things are in flux. One big beautiful bill is here. There are a lot of things you can do before the year end to make a difference to your tax liability. If you own a small business, see what type of business you have. Do you have an LLC, S Corp, C Corp? Now, one big beautiful bill has made the QBI as permanent deduction. So first 20% of your profit is not taxable. This bill was supposed to, this law was supposed to expire at the end of 2025. If you remember, the law was initially passed in 2017 with Tax Cut and Jobs Act for 8 years and was supposed to expire in 2025. Now that section has been made permanent. So if you have been thinking about converting your company from S Corp or LLC to C Corp, maybe you don't have to. So take a second look at it. C Corp taxes are still at 21% flat. They used to be 35%. There further talks about reducing the corporate taxes for at least domestic production to 15%, which is not a law yet, but 21% is much better than 35% what it used to be. So there are a lot of sections around it. If you are buying machinery, please try to buy it before December 31st, and it has to be put in use. You have to start using it before December 31st in order to qualify for bonus depreciation. Bonus depreciation can create amazing benefit. The best thing, bonus depreciation can create losses for the business. What it means is, if you recall, Section 179 depreciation, it was limited, cannot be more than the income. If you have a small business, and let's say the income is $10,000, your depreciation under Section 179 could not be more than $10,000. It was limited to the amount of net income you have, taxable income you have. But in bonus depreciation, you did not even pay. You buy a machinery for $40,000. On installment plan, you only paid $4,000. The benefit you get is for $40,000 deduction, and it can create losses. Even if you don't have $40,000 of net income, you can still claim bonus depreciation. A lot of things are changing, Sanjeevji, this year.
Absolutely. You just touched base upon Section 179, right? Section 179, can you share the limit up to how much million of dollars that they
Yes,
can?
Section 179 deduction is limited to $2.5 million.
Right.
But please, for small businesses, $2.5 million is a lot of money. For small businesses, instead of worrying about the limit, please try to buy this stuff and try to put it in use before the year end. A lot of people will come to us at the end of the year, after the year end, when we are doing the taxes in February, March, and say, how do I reduce taxes? And I said, this question should have been asked before the year end. This question should have been asked prior to December 31st. So between October 15th, which is the tax deadline after the extension, till December 31st, all the accountants of the world, all the CPAs are only doing tax planning. So if you have a small business, more money you have, more important it is for you to do the tax planning. If you have a small business, LLC, S Corp, C Corp, whatever your business structure is, if you own real estate, let's take a step back. Maybe cost segregation study would make sense this year. But how do you know? You have to look at the tax angle. How much is the taxes? If you're losing money in the stock market, well, let's do the tax loss harvesting. There is tax angle to everything. But onus, the responsibility remains on you to look into it.
Absolutely.
So please find some time, and you can save some money around.
This is a very, very important message. For small businesses, you can save so much money, but you need to start planning right now. And Science CPA Services, just a phone call away. They're experienced and knowledgeable CPAs, and even AJ himself can definitely set up an appointment with you and sit down with you and go over through details. Speaking of go over through details, how about education benefits for small business?
Amazing. People have heard about Section 529. Where people can invest money for their own kids, and then the growth is not taxable. But how about Section 127? Forget about 529. Let's talk about Section 127. This is a new thing. Small businesses can pay up to $5,250 under Section 127 for each employee, and this is not taxable to the employee, and is tax deductible for the business.
Wow.
So it's double benefit. So if you have your employees who are going through schooling, continuing education, especially in professional world, accountants, attorneys, doctors, they have this continuing education requirement. The business can pay for this continuing education, can claim it as a deduction on the business tax return, and it's not taxable income for the employees.
That is a simply amazing benefit, and a small business should definitely take an advantage of it. AJ, when there's a small business, let's say there's a small manufacturing company and everything, and they set up a business. Obviously, they also have R&D department, research and development department. The U.S. government treasury also offers a benefit to R&D portion, right?
Absolutely. So there are two types of benefit. If you have domestic R&D, it's beautiful. You can claim up to $2 million of R&D expenses immediately. Immediately you can expense it. You don't have to put it on the balance sheet. It becomes an expense directly. If you have foreign R&D expenses, they have to be amortized over 15 years. But the idea is we want you to have R&D expenses in this country. If you are hiring more people, if you're trying to develop something, if you're trying to make something new, something better, that's R&D. All of that is claimable expenses immediately in the year of expense.
All right, AJ, as we are talking about these benefits for the small businesses, tax planning for small businesses, all right, this year, so that way they can take advantage of this, the deductions and everything else in their tax return. What about owner's compensation? Is there a benefit to that?
Absolutely, Sanjeevji. So there are a lot of benefits around having higher owner's compensation. The problem is a lot of people want to have lowest compensation possible to save on payroll taxes. But if you have a small business, consider defined benefit plan or defined contribution plan, solo 401k plan. You can put up to $70,000 into SEP plan into your own retirement account and count it as tax deductible. So there are a lot of benefits if you do it right. Please explore it. If you have a small business, all these retirement accounts are only applicable for a small business. I mean, if you don't have a small business, then you are not allowed to do a lot of SEP, 401k, all those plans. You can still do IRA, but then you are limited to certain compensation benefits around it.
All right. AJ, 2 minutes to go into the show, and two very important topics, 1 minute for each. 1099 changes for this year.
So 1099 for 2025, meaning the taxes that will file in 2026 for the year 2025, still has the same limit of $600. It's going to increase next year. 1099 is typically issued to LLC, individuals, and attorneys. You asked me why attorneys are specified separately. This is how the rule is saying. If you paid more than $600 in your regular course of business to an individual, LLC, or an attorney, you need to issue a 1099 to them. If you don't have a business, if you have a babysitter coming to your home, you are not required to issue a 1099. So for individuals, for your personal, you don't need to issue a 1099. For small businesses, it's extremely important to issue a 1099. The limit remains same as in prior years, at least for this year, which is $600.
Next year, $2,000.
Next year from 2026, the taxes that will be filing in 2027, the limit increases to $2,000 from $600.
Would it hurt the businesses? That's one.
Well, actually, it should help businesses. If they are issuing 100 1099s now, they will end up issuing 20 1099, meaning if they are paying somebody between $600 to $2,000, they don't have to issue a 1099. I mean, issuing a 1099 is a process. It has a cost around it. So small businesses wouldn't have to do that because the limit has been increased from $600 to $2,000.
Okay, all right. Last point, quickly. IBITA. How does IBITA help with the tax filing for small business?
So under the OBBA, what used to be IBIT, income before interest and tax, for the interest deduction has been increased to IBITA. So now IBIT, income before interest and tax, has been changed to income before interest, tax, depreciation, and amortization. So in theory, more interest can be deducted from your small business. This is applicable only if you have large interest, large loans, highly leveraged business, and you are making more than 25 million in revenue. So if you have a business, 25 million or more in revenue, and it's highly leveraged, meaning you're paying a lot of interest expense, in that case, you have to understand the difference between IBIT and IBITA limitation on interest deduction.
Okay, very well. So we touched base upon this, tax implication issues, tax planning issues rather for small businesses in this part of the show, this second segment of the show. In case if you missed the first segment, we touched base upon tariff issue part 2 because we did tariff part 1 last week and we did tariff part 2 in the first half of the show. In case if you missed any of it, you can just go to YouTube, just type in the Tax Talk ITV and you should be able to watch it to get all the information that you really need to know. Ajay, thank you so very much for your time and guidance once again. And I am Sanjeev Pandya, wishing you all happy and tax-free days ahead. Diwali is around the corner. You'll be celebrating Diwali. So wishing you all a very, very happy Diwali to you and your family. And we'll see you again next week, same place, same time, right here on ITV Gold. Ajay, happy Diwali to you.
Happy Diwali, sir, and happy Diwali to you too.
Very good. Thank you so very much. So long.